Welcome, everyone, to another episode of the InvestTalk Classroom. Today, we're going to explore how a potential Fed pivot has a significant impact on the real estate market. Now, we're diving deep into the past 2 years to understand the shifts in real estate, discussing everything from the current market conditions to the effects of lower interest rates on home loans and what this means for investors across various real estate sectors.
Certainly an interesting time for anybody who's thinking about buying a home or generally wants to invest in real estate. With the market at a turning point, understanding these dynamics is more important than ever, whether you're, like I said, trying to buy a home or just trying to get exposure to the sector broadly. Now, when we start talking about purchasing a home and how the Fed pivoting might affect home buyers' abilities to make those purchases, I think it's first important to step back to the largest thing that influences the real estate market, and that is new things that are being made for sale and old things that exist and are trying to be sold. And certainly from the new houses being built perspective, we are nowhere near where we were even 2 decades ago. But even looking at the existing home sales, we're still in a downward trend over the past 5 to 10 years.
Yeah, and yes, inventory has started to perk up a little bit, but it's still very, very low. And we'll show this chart here, and it goes back to pre-financial crisis and shows the inventory levels of existing homes. So it does is looks at the number of homes that are on the market and then divides it by the sales volume. And so that gives you months supply of homes in the market. And so it peaked out around 11 months supply before markets crashed, right? A normal market is kind of in the 5 to 6 month supply. While inventory has gone up a little bit lately, it's still at about 4 months supply. So it's clear that the supply dynamics remain relatively tight. Now, if the Fed pivots and lowers interest rates, that's going to bring some buyers off the sideline. It could also lower the cost of capital for new home builders to go in and build a little bit more potentially. So I think overall, the impact that the Fed will have on the housing market is fairly minimal, even though everyone's going to talk about lower interest rates, and that certainly will help. The overarching dynamics of the market have far more to do with longer term supply and demand as opposed to what the incremental changes in Fed policy will be. What are your thoughts?
Now, the effect of interest rates it's an interesting point to make, but I think the dynamics, like you said before, are more driven by the supply of houses in the market writ large. So you can see over the past 20 years with this next chart is showing that the per capita availability of housing in the market has consistently been going down, even at a time period between 2009 and 2019 when interest rates were historically low. So I don't see it as much a picture of the cost of capital or the ability of somebody to purchase a house at a lower mortgage rate, so much as it is in the wake of 2008, home builders weren't willing to take on as much risk as they did pre-2008 because of the massive blow up resulting from over leverage. So there's still scars from the great financial crisis that lowering interest rates are unlikely to fix.
Yeah, it's manifesting still today. And I love that chart because so many people look at just a nominal number and they don't adjust it for inflation or, in this case, population, because that's what you need to buy a home. You need people to buy homes. And if the population is going up, that ratio is going to change. And so even though you've had over the past handful of months, the overall supply increasing is from a very low level, and on a population adjusted basis, it's still extremely low. And so, if the Fed pivots and lowers interest rates, it's going to bring some buyers off the sideline, and it's going to still be met with not enough supply. So that's why I think that on the margins, it's probably not going to have a major impact. But if it does, it's going to be certainly to the upside. But I think
it wouldn't hurt.
It wouldn't hurt.
It can't hurt, but is it going to make a meaningful difference?
Probably not. No. Now, I think what's more interesting is the impact it'll have on the investment side. If you have a portfolio that's being exposed to real estate in some way, shape, or form. We talked about home builders. They're doing well. I think cutting interest rates can only help them to a degree. But in general, I don't think it's going to have a major impact on them. What will have a major impact is on, for example, REITs, because in many ways, REITs are bond proxies. If interest rates go up or down, that's going to impact bond proxies. And so if Fed cuts rates, that's going to help the REIT sector as a whole. So today we took a look at how the Fed's pivot can affect real estate. We've navigated the complexities of the Federal Reserve's policies, lower interest rates, and their influence across the real estate investment spectrum. Thank you for tuning in to the latest edition of the InvestTalk Classroom. Please like and subscribe to this channel and our podcast, InvestTalk, and we'll catch you next time.